Welcome to the Daily Update. This is Being Prepared Friday, May 27th, where we'll look at the action in the market today and then see how things look for Tuesday, May 31st. Please be reminded that the markets are closed on Monday in observance of Memorial Day, but we had a really strong day on Friday. Didn't see a lot of selling coming in. Prices were able to go higher and pretty much stay higher, and then as the day went on, we saw even more buying. We're seeing a real improvement in our technical picture, but possibly on a short-term basis, we've overdone it. So now the question is, if we do see a bit of a pullback because we're going extreme in the short term, is that just going to pause before we get ready to go higher? Or will it be the same pattern that we've been seeing over the last few weeks, where anytime we get a little bit of strength and we fall back, then it turns into a full-blown decline? Going back over what happened on Friday, right at the open, we gapped higher, just like we did on Thursday, to above R1, which was at about 40.94. Buying then took prices up to R2, which was at 41.28. As the day went on, prices drifted at R2 and then were able to go above R2, so that's rather encouraging. Going into the close, buying continued, and we ended up closing at the high. So we were up 2.47%, a very respectable move upward. However, volume was below average and is declining. That's a bit of a warning sign. We've seen volume below average pretty much all week, even on down days as well as up days. You have a lot of people that are really unsure about things. They don't really trust this, which really could work to the market's favor. If prices keep going up, but people are like, nah, it's going to come down, it's going to come down, that sometimes works against logic, and the markets keep going up. We're still looking at the technicals, which are turning more positive now, but we still have a rather negative backdrop. The markets are concerned about inflation and interest rates. That story hasn't changed, and growth concerns. Of course, the geopolitical events that are going on around the world, as well as earnings as they're coming out. What are some comments that we can make? Will the rebound last or be short-lived? That's what we're looking at right now. Gas is starting to spike. Isn't that nice? Right before Memorial Weekend, and you have a lot of people that are going to be traveling, and gas prices are really climbing. We're still watching the VIX, but it's calming down a little bit from that irregular reading that we've been seeing. Fear still remains extreme. The S&P still remains in correction territory and will be for the foreseeable future. The technical indicators are showing continued improvement, but we're possibly overbought in the short term. The markets are closed on Monday, as I mentioned. The economic reports that came out on Friday showed that personal income increased 0.4%. They expected it to be up 0.5%. Personal spending rose 0.9%. They expected it to be up 0.6%. So, in a nutshell, you have income not going up as fast as spending. The PCE price index was up 0.2, and it's my understanding the Fed really watches this. They expected it to be up 0.3. So, this scenario that the market is trying to develop, that maybe inflation has peaked, so far in the economic data that we're getting, shows that things are still high, but maybe starting to come down a little bit. Maybe that could be the pivot point that I'm going to discuss in the video that I'm preparing. And then the core PCE price index, which takes out food and energy, of course, the things we need, it was up 0.3% as expected. The final reading for consumer sentiment, it actually fell a little bit more to 58.4, where we first had a reading of 59.1, and I have a chart to show you that. The advanced goods trade deficit actually narrowed a little bit. Don't follow that one too close. And I don't really follow this. The advanced retail inventories increased 0.7%. Advanced wholesale inventories increased by 2.1%. The condition of our trend, it's still negative, but it's weakening. We're starting to see the ADX come down. I've switched the bias over to positive, and I've also switched the momentum over to positive, but that comes with a red flag. We have a 3-day weekend. Anything can happen on any front. We might be overextended in the short term. Who knows what the mood of the market is going to be when they come back on Tuesday. So be aware of that. Then I am preparing a supplemental video where I'm going to go through and explain why do we seem to have these nice little bounces and then they fizzle out and then we go back down. Are we in the middle of one of those right now as I prepare this video? My hypothesis is that the markets are not going to be able to sustain a strong and lasting recovery until there's a shift in Fed policy that the markets like. And as I've stated before, and I'll bring this out in the video, it may not even be something that actually happens. It's just something that is released either by the chairman or somebody that's influential in the Fed, and the markets pick up on that and run with it. Just as an example, back in 2016, Chairperson Janet Yellen just said, yeah, I'd be open to negative interest rates, and the market just loved that. Even though it didn't happen, the markets used that as a real catalyst to go higher. We're kind of waiting to see. There's two areas that I'm looking at right now. Will something be released by the Fed that the markets really like? That's unknown right now. The other one is, as I just mentioned a moment ago, this scenario that the markets are thinking that maybe inflation has topped out and is starting to come back down. Maybe that will be what is really needed. The bounce is defined as either a possible counter trend move because maybe we're in a longer term downtrend and then we're just going to see a nice healthy bounce before we get ready to go lower, or maybe even a renewal of the bull market. That doesn't seem very likely now, but stranger things have happened. We just want to see something that lasts more than a few days and possibly could get back to where we were before, or maybe even hit a new all-time high. My intentions are to post this on the weekend. That's pretty much set right now. And I'll be adding this. In fact, I've already added this to the possible positive scenarios list. Let's go back and look at the day's session. First, looking at sentiment. We are still at extreme fear. Even with the advance that we've seen over the past few days, people just don't trust this, which could be a good thing. Because again, looking over here, we've been camped out below 25 for a long time now. We usually don't see that. The VIX is declining on the line chart. It's also on the bar chart, starting to drop down below both of the moving averages. The VIX of the VIX is really calming down on the bar chart, and we're closing much lower on the line chart. One thing that came out, and I talked about this in yesterday's video, only to have it updated and come out today, is the RIDEX bear-bull ratio. It actually went back up to 0.11. When I talked about it in yesterday's video, it had declined. Well, when everything started going down again, remember, people that invest like this, they have jobs. They have things they have to do. They can pretty much only pay attention to the markets in the evenings and on the weekends. And so they read what they read or watch what they watch, and then they react to that. So they tend to be behind the curve, where what we look to do is to proact. We look at things before they happen and then try to set ourselves up to take advantage of that. Here's the crazy VIX chart. We have the 5-period simple moving average of the VIX on the top, the S&P on the bottom. In the middle, this is the correlation that I've been watching, and it has come back down. I have it marked over here. We never did get up to this dashed line, but we have seen this spike before at this level. And what does that mean? Does that mean the markets could end up going higher? When we had a reading like this before, there was a decline. But then there's been other readings like this where we saw a pretty nice advance. Another thing that came out are the weekly equity fund flows. And this is, if people are feeling good, they're going to throw money into the market. If they're not feeling very good, they're going to be taking money out. And it was up 17.01 billion recently. And so we're seeing a nice little blue bar going up into equities or stocks right now. This is the consumer sentiment final reading, where that's the blue line and it's going down. We're at 58.4. That just means people aren't really optimistic about what's going on right now. At the same time, the 2-year Treasury yield has really been going up, but is it starting to come back down? It decreased a little bit. What we're noticing on this chart is there's a real spread between the blue line and the red line. Eventually, they'll come back in line with each other. Either interest rates will need to come back down, or people will somehow need to get happy and feel more optimistic about things. And you can have rising interest rates and rising sentiment at the same time. It's when they get really out of line, that's when there's a problem that we seem to be consumed with right now. The Ulcer Index is coming back down and is pretty much on the moving average. And here's the longer term chart after spiking. Equity put call ratio on a really strong up day. Yeah, we saw this fall. This is a daily chart where here is the 5-period moving average, and we're seeing a real decline right now. But it's still pretty high, but it's coming off of a pretty extreme negative reading. I want to bring up a chart of inflation just because we're seeing some things really going up right now, including the CRB, which measures inflation overall. These are commodities. Over here on the left, it shows how this index is broken down. But we've been in a really solid uptrend with the CRB ever since the COVID lows. This is what I wanted to point out, is gas is really spiking. And I mentioned that at the beginning, that isn't it nice before people are getting ready to drive, that gas is going up. Another thing to talk about is that every recession has been preceded by weaker housing. Well, when this line is really going up, that means that housing is really getting weaker. This is the U.S. Housing Cycle Stress Index. Ooh. And back in 1980, we had some real problems back then, and this line was going up. Back in 1990, we had some problems. The line was going up. 2010, after the whole financial crisis, this really went up. Where are we at right now? Even though we're seeing some weakness in real estate, it isn't really spiking up like it was before. So this may suggest that there might not be a recession. Another thing is looking at fertilizer. That's heavily played into inflation right now. It has been coming down, but it's still quite high. It's pretty much double the price of where it was a few years ago. Another thing is diesel. This is how we move things from place to place. It's coming down a little bit, but it's still very, very high. And this will eventually work its way over into the prices that we have to pay. Let's look at, I only have one chart for valuation here that I got from IsabelNet. This line right here is, it's a linear, I know it's going up, but it's a straight line. And it's the real market cap divided by the real GDP ratio. And as market cap and GDP have been going up over time, that's why we see this line going up. When we're above this line right now, that means that things are getting pretty out of control. And this is back to the 1960s and 70s, and we were in a bear market at that time. When we drop below this dashed line, this is more favorable to the stock market going up. And throughout the 80s and 90s, we were in a pretty good bull market. Then we got ahead of ourselves into the dot-com bubble, came back down, then we started to get back up above this line into the financial crisis. Then everything came back down. We didn't really do all that much during the COVID plunge just because that happened so fast. But look at where we're at now. And they're calling this the everything bubble. Everything is expensive right now. This could portend to things not being very good in the future. Let's go through and look at the sectors. All of them were positive, with discretionary, which has just been getting hammered this year. Tech, real estate, materials. The ones that had been weak, communication, they did very well on Friday. And the one that did the worst, the staples, and it was up 1.16%. And here is a chart still showing energy in the lead, followed by utilities. Discretionary, my goodness, just a few days ago, it was down, I think, 34%. Now it's down 26%, which is still terrible, but well off of what it had been. Communication, tech, and financials, as well as real estate and industrials. These are all still down double digit in the tens, where communication is down over 22%. Technical alerts. Decision Point had a little change on their scorecard. In the short term, their PMO signal, which is what we're showing on our chart as well, it's now switched back to positive. But all of the signals that we saw on Friday were positive. We saw some BPI crosses in some sectors like the tech sector. Even the S&P finally went above 50. The NASDAQ went above certain levels. The S&P went above 4,100. Healthcare, industrials, a lot of these are BPI crosses that are going above 50. And then oil, which is really kind of sucky right now on a personal consumer level, it's above 115. Let's go back and look at the intraday chart. If you look at Thursday and Friday, it's a very similar pattern to what we saw, where we gapped above R1, and then we were able to continue buying and eventually make it all the way up to R2. We danced along R2 for a part of the day. If some selling was going to come in before a 3-day weekend, before a negative market, you probably would have seen it at about this time. But no, that didn't happen. So then some buyers came back in. We shot above R2, kept going up, and actually closed at the high for the day. So it was quite positive. But one of the things I've learned in watching the markets for decades is you'll see some of the biggest up moves in a bear market. You'll see some of the biggest down moves in a bull market. Yeah, it's nice and things are looking a little bit better, but at the same time, we have to be cautious right now. We were able to get back above our long-term support. We ended right at that level on Thursday. Well, we bounced above that and actually were able to get above the pivot as well. This is looking much more positive from a support and resistance point of view. But look down at the bottom where volume was below average and is declining. We're down 13.31% from the all-time high. Technical overview. This has not changed. It's going to take a lot for these things to change. All these things here are still positive overall in and of themselves, as well as on a relative ratio basis. All the negative things still continue to be negative, even though some of them are showing some improvement. Looking at our trend, we're seeing the ADX starting to roll over. It's still above 20, so it's still a trend. The red line's still on top, but look how close the red and the green are to each other. They may be getting ready to cross. The Arun's not really picking this up because it's just going back into areas that we've been at not too long ago, so it's not making a lot of adjustments on price. But it is seeing a gradual decrease in selling, and we're a little bit flat on buying, so we turned up ever so slightly with our oscillator, but we're still negative overall. Looking at breadth, this is just a one-day chart of the advanced decline ratio, and we have spiked up right now. This is one of the reasons why we might be overextended on a short-term basis. But looking at our advanced decline study, we're really showing an advance based on price. We're seeing some much improvement based on volume. The advanced decline ratio is also showing some improvement, and we're getting up near extreme positive territory with the 39 period moving average. The new highs and new lows continue to go up, but we actually turned over a little bit on Friday, where we're still headed higher with a little bit of a blip to the side based on the 10 period. Accumulation distribution is showing improvement, and the moving average is starting to turn back up. One thing that's also extreme positive right now, it's the 19-day EMA of the advanced decline ratio. We're getting extreme positive right now with that. We could still go higher, but this is above the line where it's usually getting extreme. Here's something that I picked up. This is market breadth as measured by the NYSE. Now, I focus on the S&P 500. If you want to get a broader measure, and I have lots of charts, but I don't show them in the videos, where I analyze what's happening in the NYSE. But I feel that we get more relevant information by just studying the information that comes off of the S&P 500 itself. But it says in late 2021 and early 2022, we saw a failed breakout as well as lower highs for the advanced decline line. So here, we tried to break out, and then it came down, and then it came back up and set another high. This is a bearish divergence or a negative divergence where we didn't go back and surpass this previous high. Throughout 2022, this indicator has declined as narrowing breadth has either preceded or confirmed lower lows on the S&P 500. We ended up breaking down below support levels. First, we did it in January. What had been support now becomes resistance. We go a little bit lower. We try to rebound. That didn't really work out so well. This was back in March. We've been going lower ever since, and we're making a new low in 2022 so far based on this. Can this improve? This shows inside the market what's really happening. We can look at a nice, bright, shiny car, but we eventually might have to open the hood and look at the engine. This is the engine. This is showing us what's going on under the surface. So we want to be aware of that. And I've been talking about this in the videos. This just shows it displayed in a little bit different way. Short term, 1 day rate of change, extreme. We might have overdone it. 5 period, we might have overdone it. The S&P ended up having a pretty good week. McClellan oscillator, extreme positive. Force index, it's positive and not necessarily extreme, but we're hitting the upper end of the Keltner band here. And that just means that we're going up pretty fast. Stoke RSI, extreme positive. Williams percent R, also extreme positive. Our moving average steady, 20 period, getting extreme. 50 period, advancing nicely. 200 period, advancing and showing improvement. Stochastic, short term, extreme. Intermediate term, going up and not quite extreme. Seeing improvement with the longer term. Looking at our intermediate term charts, pretty much all of our oscillators have now crossed over positive. So that's a good thing too. We're seeing some momentum moving in the right direction. We still have moving averages to deal with. We haven't gotten back to anything other than the 20 right now, but at least our oscillators are looking more positive. The vortex, it crossed over. The red line crossed below the green, so now this is currently positive. Swinland trading oscillator, getting a little bit extreme based on price and volume, but still showing some strength. BPI, this is where we crossed above 50. And that's nice and healthy looking right now, unless things fall apart. PMO, crossed over positive, looking better based on price and volume. And we actually saw this a few days before the PMO crossed positive. PMOs that are rising, looking a little bit extreme. Buy signals going up and not necessarily extreme. Those that are above zero is starting to turn up. Summation, based on price and volume, is positive, and we're starting to go above this line. This is the negative versus positive line. So we're looking a little bit better based on volume. The CCI in 14 periods, starting to get extreme positive. The 20 period that I often show, it's not extreme yet, so I didn't bring that chart up. Ease of movement is starting to get more positive, and we're going above the dash line. The boom indicator looking a little bit better. It's not quite above zero yet based on the 50, and we're seeing a bounce based on the 200. This is a concern. As we've been going up here, volume intensity has been dropping off. Connors RSI starting to give us an extreme positive reading. TTM squeeze showing some improvement, but has not turned over to blue yet. It won't do that until we cross above these green dots here. We were able to get above this anchored moving average. And longer term, we're showing some real improvement when we use this like an oscillator. Our different charts, Heiken Ashi, looking much improved. Kegi chart, also turning more positive. Renko, yeah, we have an open box. Haven't seen one of those in a long time. That's positive. 3-line break, also looking more positive. Added 2 more X's to the point and figure, and we have a bearish signal reversed, generated on Friday. Our different trading systems, positive on the S&P as well as the SPY. We're still positive on the SAR. Our go, no-go is still more neutral. It's the lighter shade of purple. We want to see these things turn blue. Let's go in and look at our long-term trend. We are still below the 200-day moving average. We're about 100 points or so away. Our longer-term moving average study shows a lot of improvement with the 50, 150, and 200. The special K, it's turning up ever so slightly, but it has a long way to go to get back to the moving average. Looking at the fib levels here, the reason why I brought this up, this measures a low set back in 2021 all the way to the all-time high. We came down to the 61.8% retracement level and then fell through that. Well, we never made it down to the 100% retracement, but we've been bouncing back up and we're slightly above this level, which had acted as support where we were coming back up. This could be acting as resistance unless we can break on through to the other side. Looking at the broad market, we're still positive with the diamonds as well as the Qs. The Vixen is showing a real decrease because we're seeing fear coming out of the NASDAQ 100. both with the bar, we're below the moving average and on a closing basis. I wanted to bring this up to just show that the tech to 10-year correlation, it's pretty much back to neutral now. Internationally, we're seeing some improvement. China is turning back up. Emerging markets is trying to go higher. Europe, Japan, as well as the US. Broad market, we're looking at the dollar. After spiking up almost to 105, we have been coming back down. We're still in an overall uptrend, but what we're watching is, have we spiked? We're getting back down to this red line now. Are we going to keep going down? Are we going to be able to turn back up? The euro, this is what Goldman Sachs is thinking will happen in the future. You have the euro against the US dollar. The euro is listed first, so that's what the chart is here. The euro has been coming down. They think it's going to eventually bottom out and then go back up. That means the euro will go up as the dollar goes down. Looking at oil, still very high. It was up 0.86% right before a 3-day weekend. We're at 115.07. The gold futures are still staying above the 200-day moving average as well as on the ETF. And here's the longer term look there. With the silver ETF, we're looking at a death cross right now. We did advance 0.25%, and this has been a nice little upward move. But when you put the moving averages on here, we've been below them for so long, it's starting to register a negative trend. And here's the longer term view of the ETF. Looking at bonds, seeing a bit of a bounce. As interest rates come down, that means that bond prices are going up. It had been very, very oversold. Can it continue? If bond prices keep going up, that means interest rates may be coming down. This is a daily chart showing how the yields have been going either up or down. Here's a weekly chart looking at the international yields where we've been coming down in the US, bouncing up in the UK, going up slightly over the past week in Germany, and then we're keeping an eye on the red line, which is Japan. And notice how they've been really flat lately. Another correlation that's gotten back to neutral is the S&P to the 10-year yield. They were moving in opposite directions. Then they were moving pretty close in lockstep. Now they're back to just kind of going whichever way. Intermarket analysis. It's showing that oil still has been the best performing asset since the beginning of the year, followed by the dollar. Below that is gold, which is up slightly. On the negative side, we have the S&P, which is trying to turn up recently, and bonds, which may be turning up, but it's a little too early to tell. They've been the least well-performing asset in 2022. Our possible positive scenarios. The Copic curve continues to go up. This doesn't measure the direction. This just says something could be happening, and right now it looks like it is. Has the 2-year yield in the Treasury spiked? Other times, this can mark a shorter term bottom in the market, and we see a nice little move up from that. We're coming down slightly here, but we want to just keep an eye on this. The mass index finally generated a signal. The first part of the signal is when it goes above 27. The second part is when it drops down to 26.5. It finally did that. Again, this doesn't measure the direction. This just says something big could be happening. And since we've been going up lately, does that mean things are going to continue going up? This does pick lows in the market with the Pring bottom fisher. That's looking more positive. And the small caps, they spiked up a little bit here. Can they keep spiking up, and will that help the S&P 500? This is looking more viable again. The Staples spike, we had spiked up here, came back down, then bounced back up. Now we came back down. If this continues to go down, this could mark a more significant bottom in the market like it has in the past. So what's our outlook then for Tuesday? The technicals are turning positive, but we could be overbought in the short term. Sentiment remains extreme negative. Growth against value. Growth has won the last few days. What's going to happen in the coming week? The economic reports coming out on Tuesday are consumer confidence. Geopolitical events, the same if you've been watching the videos. This could be either positive or negative. Russia, Ukraine. They're still lessening the lockdowns in China. That may help the supply chain. The markets are still fixated on inflation and interest rates, which is producing growth concerns within companies. We want to keep an eye on oil. earnings as they come out, any Fed speak if they're giving an interview or a speech, and then policy. And this is what I'm going to address more in the supplemental video, and then we're just keeping an eye on Japan. So what are our scenarios? We're still negative overall because of all the reasons that I've just talked about. And I won't read those off again. The one that's a little bit different here is the recent trend of selling into strength. Is that going to happen in the upcoming week? Or will we be able to establish more of a meaningful uptrend? The technicals are negative, but turning positive. So what can help us go up from here? The technicals are looking better. That can help us go higher. And sentiment still remains extreme negative. And our possible positive scenarios. The Copic curve and Pring bottom fisher have turned up, so they're generating signals now. The staple spike is looking a little better. The mass index has finally given us a signal. Now we're asking, have 2-year yields topped? And then the Fed pivot, and I'll be pretty much addressing that in the supplemental video. This is something happening in the Fed, and right now what I'm thinking is if interest rates have topped out and they're starting to come down, that might be it. Or is it going to be some kind of policy that the Fed comes out with that the market latches onto? It may not even really happen, but it's something that the market sees. Okay, the Fed is really involved here. We like it. We're going to take things higher from here. Then the technicals, which are improving. We have pivot points. The short-term moving averages were still above the 20. Any fib retracements and previous levels may either provide support or resistance. We're not in a neutral trend right now because the ADX is above 20. So what's our conclusion? The S&P is negative, but it could be turning positive. Short term, positive, but possibly overbought on a short-term basis. Intermediate term, it's looking better than it was. Long term, we are still negative. So thank you. I hope you have a wonderful weekend. Please let me know. Earlier in the week, I did some videos where I zoomed in on some charts. Let me know what you think of that. And yes, I'm purposely running this out a little bit longer so the end cards, when I post this to YouTube, don't overlap some of the things that I'm saying on the other slides. But let me know what you think of that. If you have any other feedback, if there are charts that maybe I could zoom in on or others that I don't, it does add some extra time to what I'm trying to do here. But if I have the time, I can certainly try to include that.